importantly, we've got a couple of interesting folks here, and we've got an interesting topic, and this is one that we've been batting around for a little bit, and one that's a little bit near and dear to my heart. I've always been looking for product managers that have a view or an understanding of the commercial aspect. How does my product make money, and what's important right now? And as we've thought about this topic and we discussed it, actually we realized it's not as simple of answer as just watch revenue and watch costs and boom, you're done. There's actually different stages where different things are important. And so Audrey, Bradley, and myself, Colin, the ABCs of product management, if we could brand it that way, decided to get together to share a few thoughts of what we think are kind of some of the most important metrics at different stages in the company. So I'll let them introduce yourself. Yeah, we're really excited to share with you some thoughts, but of course we want the discussion as well. So feel free to jump in with some questions as we go. Hopefully at the end of this, you'll have a greater appreciation for your finance team, your marketing team and sales team, and maybe start some interesting conversations with them next week. So my name's Colin Bauer, and I'm the head of product at Gentrack. I've been in product at Pushpay, Orion, and done all kinds of things for many years. More importantly, I've had the fortune of working with this lovely person I'll hand the mic over to next. Actually, sorry, no, I'm going to go Bradley first because Audrey starts off with.
20 years.
But well, we're still finding ways to work together. So Bradley, we'll start with you. Yeah.
Cheers, Colin. All right, my name is Bradley Scott. I'm Chief Operating Officer at Unique. I'm going to spare you the pitch. If you want to know more, digitalhumans.com. So my role at COO includes product management and development, although both of those things are handled by very capable people in my team. The other areas are customer success, and from the new year, it's actually going to be finance. So we've got a part-time CFO, but we wanted to move the day-to-day around the organization, so I'm going to be picking that up. Don't have a formal finance background, but sniffed around it enough that they decided that that might be a good idea. So hopefully that goes someone to making me credible in this talk. So hand it over to Audrey.
Thanks, Bradley. I think I need more hands. Is that all right?
I'll just hold on top for now.
Oh, that's okay.
No,
I gotta manage. Hi, everyone. I'm Audrey Cheng. I'm the Chief Product Officer at a company called SnapComms, and we do employee internal communication and employee engagement. I've only recently joined there, maybe in the last 4 months or so, which has been really great, growing a new business again. Prior to SnapComms, I was the VP of Product at Pushpay, and I was there for over 6 years. That was an incredible journey. I spent a lot of the last maybe 15 months to 18 months spending a lot of time with the CFO. And so that's when I started really to understand, the metrics that are really driving the business. So that's why when this talk came up, we decided that was something that I think as product managers, sometimes we focus a lot on our own product metrics, but we don't really understand necessarily how that drives the business, and what we're working on helps to add to the value of the business. So that's who I am. All right. So I guess if we get underway, we wanted to, I guess, start thinking about, a case study, like as a company, like there are various stages of organizations. And I think we wanted to caveat before we get started really is that, everything is contextual. And so what we're saying here today is not a playbook for you. It's not something that you can necessarily go out and say like, hey, just take all these metrics and think about all these things. We just want to give you some food for thought as to what's important to different businesses at different stages of its life cycle. And so we're going to go through 3 different stages today: startup, growth, and sustain. And what those metrics look like becomes important at what time in an organization. So if we think about like the Acme Corporation, we think about like you have a customer, you have a problem, and you have a potential solution or product that you think you want to bring to market to solve it. So I don't know how much everybody knows about Acme Corporation. I know I've had some interesting conversations about Acme recently, ACME, for people who are probably born after the 1990s. But anyways, what we're talking about here is Wile E. Coyote and the Roadrunner, and obviously the Acme Corporation, who provides a lot of the inputs to trying to help Wile E. Coyote solve those problems. So I'm going to talk a little bit Colin and Bradley will talk about the later stages. So when we're thinking about startups, what's really important to an organization at this time is really thinking about product market fit. And a lot of the investment that's being made is really about finding that product market fit. We have an idea, we think we have a solution to a problem, we think we know who is, but a lot of the investment right now in terms of our go-to-market is really trying to pitch and make sure that we can actually find customers who actually want to buy our products, right? And so we're not only just testing our product, but we're actually also testing our value proposition and actually finding who is this message resonating with, and it may not always be who we think it is from the outset. So you can sort of see on the right-hand side that there's a lot of solutions that Acme has, and I think part of the thing that we can relate to is that there's many ways to solve a problem. And I think in this early startup phase, we're trying to figure out what's the best way to solve these problems. And that's what the startup phase is about. It's important, sorry, this is super tiny. But I think what's important right now when to an organization is both growth and thinking about fundraising in the future. Right? And so growth of the organization is like, hey, how many customers can we acquire? Customer acquisition is extremely important at a lot of investment across the business is going into acquiring customers, trying to validate your value proposition. Do you have the right fit? Do you have the right customers? Are you looking at the right people? And so there are a number of metrics that go into understanding whether that is going to work out for you or not. And maybe you're going to find that actually there's an opportunity there that with the customer segment that you hadn't expected. And the other side of that growth is the fundraising aspect. And I think they're somewhat related. But I think in this early stage, you're also thinking about, well, if this does start to take off and we do want to grow, then we're actually going to have to think about the value of our business and how much can we grow and will we be able to raise funds? Because ideally, at some point, you're going to want to be pitching the value of your business and also the opportunity that's ahead of you. And you're going to want to give away as little as possible for that. And so at this early stage, I think the startup is really thinking about those two things, growth and, raising capital in the future for more growth. So metrics that we think are important at this stage are thinking about your total customer number, right? And RPIC. And so to unpack both of those, the total customer number is really thinking about, how many customers are you able to sell your product to? How many can you get to acquire? Are you building this product for one person? Is it just Wile E. Coyote? Is it Elmer Fudd? Is it Sylvester? Can you add more different people who actually want to buy your product, or are you really building this for one person? That helps you to determine, do you actually have a fit in the market, or is the use case that you're thinking about really specific to a smaller subset, and you might want to rethink your positioning at that point. And then your RPIC is your average revenue per customer, right? And so this could be your SaaS fees in addition to your one-off service fees, et cetera. But it's kind of giving you an indication of how much are customers willing to pay for your services, right? And so the importance of RPIC is that it is commonly out there, but we are going to talk about another metric that helps to give you an understanding of the subscription revenue. And that's your MRR. So that's your monthly recurring revenue. And this is probably more important in my view in terms of something that you'd want to track. The monthly subscription revenue is what your customers are willing to pay you on a monthly basis to solve the problem that you have gone to market with. And if you're solving that problem really well, then they're going to hire you every month and they're going to pay you every month to solve that problem. Right? And this is a really valuable metric because it can give you an indication of predictability of your revenue. If you have some seed funding or you had some bootstrap funding that you started off with, there is going to be a timeline where that ends, right? And the MRR that you're adding is going to hopefully replace that investment cost that you originally had. And so it's going to give you some sense of predictability of revenue over time. And this is really important in terms of building the value of your business and for growth in the future. So thinking about your month-over-month growth in MRR is a really good indication of how your business is growing and how your product is resonating with the market. All right, so I put in some sales metrics in here because I think it's really important about what's happening in your sales pipeline. So I've put 2 in here, which is your sales lead velocity rate and your lead conversion rate. The sales velocity rate is really about how many qualified sales leads are you getting through the funnel month over month, right? And you're hopefully going to increase that. What you're looking for there is to see, like, who is this message resonating with? Are we seeing that with the right messaging, we're actually able to address the right target audience and seeing them flow through the funnel as qualified leads. Now, what's a qualified lead? So that varies, right? And I think that's up to every organization to determine what is a qualified through your marketing funnel, that if they request a demo or they go through a trial, that becomes a qualified lead. Every organization will need to make a determination on what is the best signal for them as to what actually classifies that. But what we're saying here is that you should be getting month on month, you should be seeing an increase in the number of leads that are coming through that meet that metric. The lead conversion rate is really how many leads actually convert to an actual deal for you, right? And I think the important thing here for product managers is really understand who is coming through that pipeline. Are you hitting the right people? Is it your target market? Maybe it's somebody different than you had expected. And it allows you to actually tune your message, your value proposition, and ultimately think about like what your roadmap looks like and who you're building for. All right, with me. Churn rate. So this is one I think that we talk about a lot. It could be, it's the retention, right? So it's your customer, it's thinking about your customer retention. How many customers, so when we talked about, you know, your customers month on month hiring you again and again to solve that problem. Your churn rate is when your customers say, actually, you're really not solving my problem, or the value that you sold me doesn't really stack up to what I'm paying. And so, you know, sorry, I'm going to leave, right? And so you're thinking about what that churn rate looks like how many customers are slipping away each month, how many new month, this month. And I think in the very early stages, you're not really worried about this, right? You're worried about acquisition. You're really worried about getting new customers because you actually don't have very many customers in your book of business, right? But as you start to grow that, start to grow that book of business and as you start to grow those customers, you want to keep an eye on your churn rate. You want to know how many customers are leaving you each month. And I think more important to that is thinking about the churn MRR as well. So you need to think about like, hey, if my net new MRR is $100, am I losing $100 also at the back door, right? This becomes really important for you to think about, you know, how much are we gaining and how much are we losing, right? And it becomes really important to think that you should hopefully be seeing that you have a lot less churn and a lot less MRR churn than what you're seeing in your net new ads. All right, and the last one is cash burn, right? So we all know that, you know, nothing's for free, right? And we have to make best use of every opportunity that we have. So if you have raised capital, you know, capital is very difficult to raise. It's a distraction for a business, right? And so when you're thinking about, you know, where you're spending your money, what investments that you're making, cash burn's a real thing. And so the more that we can add like MRR into our book of business, that we can rely on some predictability of revenue coming in, you know, we can have an understanding of like, hey, where are we spending and where are we investing our money? And so cash burn is something that businesses are really thinking about. Your CFO is probably worried about the $0 day, right? The day that comes when we no longer have any cash to pay out, right? So the cash burn is how much you're spending each month to run your business, to try and acquire those customers, to prove out your value proposition. And this is something that businesses are really thinking about. And as product managers, I think we need to think about in terms of where are we making those investments and to looking at all the signals to figure out how do we make the best opportunity with what we have. All right, so the implications for product managers, again, just sort of to reiterate the things that we had covered, is just really like understanding where you're seeing success. So when you look at that sales pipeline, it becomes really important for you to know like who is your message resonating with? You know, who is the value proposition resonating with? Can you make adjustments? Can you make some changes along the way that actually really hit those high notes? And who are they? It may not be the people that you had originally expected, that actually you have a very strong value proposition. It can also help you to choose you know, what your prioritization is like. And sometimes you're going to choose to prioritize things like onboarding and implementation and things that will help you reduce the time to value for your customers so that you can reduce churn or that you can get time to value for your customers a lot sooner. So there are things that are not necessarily features that you may necessarily build, but your pipeline will tell you the things that you need to do in order to, one, acquire those customers and two, retain them. And I think at this stage, it's always important to know that you're testing everything. You're testing your go-to-market, you're testing your product, you're testing your messaging and your value proposition and the market segmentation that you have. So this is a real testing phase to learn, and you should be open to thinking about, hey, who is this resonating with? And if it's resonating with somebody else, you really need to do some deep thinking about, is that the market we should be going after? Is that the real opportunity for us at this point, right? And so you should be open to thinking about this. And I think the last thing is really thinking about retaining your customers and your net new MRR. So those are some of the things that I think in the early stages are really important to be aware of as product managers, that really can influence the way that you think and the way that you're making decisions. And with that, I'm going to pass to Colin.
All right. So while we're transitioning in here, how many people know how many customers they have in their current book today? The exact number. How many people know the number that have left you in the last 6 months? How many people know their MRR or ARR if you're an annual business? Okay. So, I mean, for the folks on the live stream, that was probably about, less than half of our audience knowing those numbers. And look, there's different numbers at different stages, but you'll start to see some themes through it. And part of it is the lens that you put through it. But it's important that you know those numbers, because you're making decisions every day that affect those numbers in a lot of cases more directly than you probably expect. And so it's always useful to understand it. It also helps you unpack how the business makes money. Because as we move to this next stage where you start to have product market fit, where the product is now starting to pull you, the customers are coming to you, you're not seeking them out, you're not doing as hard work. Your business, your CFO has gotten really excited. They probably maybe raised a Series A or a Series B. They've got a lot of cash in the bank, but they've got investors now. They're saying, okay, show me what you can do. And so they've gone out and hired their first VP of sales. They've brought in some BD, account directors, business development reps. There'll be all kinds of names for various sales folks, but they'll be building a sales machine. And what does sales want? Sales. And when they look at the pipeline, they want numbers. Do they care what the numbers mean to you as a product person in terms of what you need to build? Not necessarily. As long as they close the deal and get their commission check, they're happy. And so in scale up, we've actually got a slightly different set of problems here about making sure that we can scale properly in the right areas. It's very tempting in this stage to make sure to go off track. And so what we're really focused now here is on market share, but the right type of market share. Because you'll find in any business out there, most businesses will not fail because they are starving for things to do. They will fail because they're trying to consume too much. And so you need to grow the right type of market share. And so the scale up stage is about keeping an eye and developing a language as a business with all the information we've learned in the startup phase towards now what is the right type of thing and what is the wrong type of thing. And all of that's about getting you traction and scale so that you can do one thing really, really well and make money off the N number of customers. So there's two main concepts here that we want to talk about. We want to talk about traction vehicles and language that's going to help you manage focus, and we'll drive into some metrics. But as Audrey mentioned, you're going to be experimenting a lot in the startup phase, and you're going to try and find what's working. Unfortunately, in the scale-up phase, you're going to have lots more people. You're probably going to have a marketing team at this stage, and they're going to be out there experimenting with SEO and events and all these sorts of things to try and figure out where do they get people that are interested. And so now you're deciding, actually, what is the thing that I'm going to get really good at this point? And they're now going to start to build a team around that. And so wherever it attracts customers, you're going to have a role in product because you might be producing collateral because you may not have a product marketing team at this stage. You're going to have to participate perhaps in doing some of the demos. I know I've certainly done my fair share of sales calls. Likewise, your sales model, you have to think about that and in terms of, are you going to do self-service? Are you going to have an inside sales team? Or are you going to use somebody else's marketplace or platform? I keep hearing Xero wants to build a platform someday and make the next couple of millionaires. So there's a couple of Xero folks around here if you want to use that as your sales model. But more importantly, you also are now starting to look for bottlenecks more intently, because at scale, it's not about adding 1 or 2 customers at a time. It's actually, how can I add 10? How can I add 50? How can I add 100? Now, of course, mileage may vary. So for example, at Gentrack, we're what I call a low volume business. I add, 1 to 5 to 10 customers a year at most. So actually for me, the bottlenecks are about how do I get to contract value, every time, and how do I do it without taking 2 years to do that? If you're a high volume business, it's about how do I onboard 10 customers simultaneously at the exact same time with 1 person. So your bottlenecks will vary depending on the type of business you're building. But as that channel keeps feeding the beast, feeding that sales engine that wants their commission check, you're going to have a challenge as a product manager to maintain focus. And so you can use financial metrics to help drive focus. But you're going to need some language and that you're going to be able to use with marketing and sales and your CFO to describe why you're not interested in pursuing that $2 million deal. You're going to need language like segmentation to be able to say that $2 million deal versus that $2 million deal. The one that I don't want takes me into a different segment of the market that we're not ready for. You know, we're not ready to go into the enterprise market. Our focus is on the SMB or the mid-market, or maybe we are focused on enterprise and don't want to go down. You want to watch on things like sales incentives. You know, as an ops person I worked with said, if you want to understand salespeople, just simply look at their comp plan. That will tell you exactly how they behave. And again, as a product manager, you know, it's not our job to run sales, but you've got to be interested in this. And so it's a bit of your job to become the VP of everybody else's business, as one of my former colleagues like to refer to his interests are. And the reason is you're going to need to develop a language around, is that deal going to help me build the plane that gets off the tarmac, or is it going to help me build the runway? You know, it's all tactical stuff. It's not really the deal I want. So let's not overinvest in it. So you want to understand that sales model. And again, you just need to be interested. You just need to be able to speak their language and develop a relationship with them. And then for us as product people, we need to defend our investment, because in the startup stage where cash and capital was really hard to come by, or very, you know, very precious in scale, you might have access to lots of cash, but you can find that lots of cash brings lots of problems and you can burn through it really, really quickly. I recall in a previous role how we burned through 120 million in IPO money inside 2-3 years, and then suddenly found ourselves not getting off the runway. And so budgeting work, and Rich Mirnoff talks a lot about this, is your actual execution strategy. And so developing that language and playing that back inside the business is really important. So there's a bunch of things here that you got to get interested in that are beyond what feature should I build next, what the customer say. And you don't need to own it. You just need to be familiar with it. You need to be thinking about it, because the actions you do may be influenced. And in fact, they will be influenced. I shouldn't say maybe. They will be influenced by this. But it's all about focus. You're building for the roadrunner. You're trying to build instruments that will help him capture his adversary. And when Foghorn Leghorn comes along with a really great idea, he'll be smooth talking, and he's going to really kind of, oh yeah, come over here, son. And you're going to not want to be swayed by that. You need that language in place to defend it. Because if you get lost into every little deal, if every language and conversation becomes about individual deals, you've missed the opportunity. Segments, not deals. That's our job as product managers. So you need to develop that language. So let's talk about a couple of those metrics that are going to matter to your CFO, to your board, and to your sales team. So everybody's probably heard of TAM, total addressable market, but actually there's a couple of other dimensions around that are really important. There's potential addressable market, which is if I could have unlimited funds in the world, these are all the people that would buy anvils from me or dynamite. But realistically, I'm going after a subset of those folks that I want to actually, and that's my TAM. And that might be people that have adversaries. So everybody in the world might need dynamite if you're in construction, but I'm going to go after people that have adversaries. But then you've got SAM, the serviceable addressable market. And these are the people that you can actually reach through your existing sales channels. Because again, you know, my TAM could say, you know, for example, as Gentrack, I can go do billing software in Greece right now. Well, the reality is I don't have a sales channel. I don't know anything about the local market. And so it's not really the market I can touch. So SAM is about the market I can get to today with my existing sales and marketing vehicles. So it brings the volume down. And then we get to SOM, which is my share of market. And again, different organizations define this in different ways. Some people, market is the share of market that I can obtain and will win. And some of them say it's the ones that I have. You'll have to define that for you as a business so that language in the business, when we talk about our market share, is appropriate. But if you talk about this, you know, everybody gets excited about TAM, but it's actually the gap between TAM and SAM that's probably the most important part, because that's the reckoning. You know, like, yes, my total addressable market as Gentrack could be every energy company in the world. But the reality is I'm not prepared today to sell into the really small energy retailers. You know, even if one came to me tomorrow and said, here's some money, you know, my sales channel is just too expensive. My onboarding channel won't bring it on. My pricing's way too high. So my SAM brings reality into the mix. But likely your CFO, your CEO, they'll have gone and pitched around TAM, because that's what investors love. They love to hear about the pie in the sky opportunity. But our world is about SAM and SOM. So think about the numbers there, and think about the rules of what goes, what qualifies for each of them, and develop that language with your sales and marketing team. That'll help you be much more realistic. So as you're acquiring customers, at this stage, we're not into profitability at this stage. So you're looking at growth rate. And so where before you were adding MRR, and look, different companies are monthly, some are annual. So this can be MRR growth rate. At this point, you're looking to make sure that you're growing your ARR. And now that you're adding 10 and 20 and 30 customers at a time, you're really just looking for this to be a really big number. And the guidance is, for the rocket ships out there, you're on a rocket ship when every year everything's doubling all over the place. So if you feel like you've got double the number of customers, double the amount of revenue, double the number of people, you're probably on a rocket ship, and that's a really good growth rate to have. But different businesses will have different growth rates. It's good for you to be familiar with where are we on that trajectory. And of course, again, your investors going to all want to see a hockey stick. It's always about the hockey stick. But why is ARR growth rate important? Well, when you're just starting to grow up, you may be thinking to yourself, I've got to automate everything. I've got to get humans out of the thing. Well, in that early days when ARR growth rate is going up, you actually may not want to automate everything, because not everything may stick around as you get to a larger stage. So ARR growth rate is going to help you prioritize as a product manager to say, when that goes up to the next double-digit increment, what's going to break? And that's going to help you decide and help prioritize what's important, what's not, because everything is going to feel like it's on fire all over the place. And you need mechanisms to decide which fires are you going to let burn and which fires are you going to attend to. And so ARR growth rate is going to help you, because you always think forward and say, in 12 months, what's our growth rate going to be? I'm going to start thinking about fires that are going to hurt me next, not the ones that are going to hurt me in 24 months. The next one is CAC. And this is your first start of thinking about the next stage and thinking about how do I acquire customers, and what does it cost me to do it? Now, again, as we mentioned, definitions, context matter here. Different companies define CAC differently. Some companies, especially public companies, use CAC in their public reporting, and they play around with the definition of CAC. What's important for you, kind of like all of this, is define a language in your business. Does CAC start at the lead stage, the minute somebody says, or somebody shows up on a lead list, and every activity from there on in counts as customer acquisition? Does it end the minute you secure that recurring revenue? And so it's one of my debates I like to have as a product manager is, for me, CAC ends the moment I've locked in that recurring revenue. The minute you've issued your first bill, utility billing side, you're now using me. You can't turn away from me because I'm now part of your business. And that for me is when CAC ends. But my sales folks, for them, CAC ends the minute they sign the deal. So it's important that you get that definition right, because then you can use that as business to say, what are we doing to bring down CAC? Because you'll need that for the next stage. And you really want finance watching this. It's really important as product managers, you don't do this in Excel. Been there, done that. Not very scalable, kind of painful. But more importantly, you don't develop that organizational wide buy-in to this metric, and why you're making that investment to bring down CAC, because it matters for us in the business to get to the next stage. So think about CAC as a way and start watching it. It's going to be important when you hit that next stage. And the other metric, of course, is NRR. How many customers do we retain? So in your startup stage, into your growth stage, it's all about acquisition, grow, 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 grow. But that's all about the front book. That's all about your customers coming on board. And you can keep filling it up, but if you have a hole in the bottom of your bucket and customers start falling out the bottom, or worse yet, they use your product less and less and pay less over time, at the end of the day, you're never going to get to the next stage. And so you got to keep an eye on your net revenue retention. How much money sticks around over time? Previous life, they did is by cohort analysis. So it's not looking at your entire customer book, but a customer that started with you 12 months ago versus 24 months ago versus 36 months ago, where are they in terms of what they're paying today versus where they started? A really interesting story, so you can figure out whether or not you made the right promises at the front end. That will ultimately is the assumption of your entire business case that says, if I do all this and get a customer at this price and my costs are this, then maybe I'll make money. So NRR is an important metric, again, that you want to get your finance team excited about tracking, because their tools should hopefully do this for you if the CRM and the finance tools are all lined up, so you can get to this. And again, you get a flavor for, are you doing the right things, or are you simply just ingesting a lot of pineapple lumps, I believe was the project name we had at one of my organizations, where the goal was just to try and get as many customers so we could hit the number, but then they'd probably all churn at the end of the quarter, which isn't really a sustainable business, and it's not going to get you to the next stage. So at this stage, it's really important where in the startup stage, you're focused on your product, find your first customer, get them on board, make sure they're using your stuff, get to customers 2, 3, and 4. At this stage, you've now got to start to look beyond product and start to look at what's happening in other functions. How do you develop some language using finance, the universal language of business, to talk about what are we doing and why are we doing it? Because focus is the thing that's going to kill you at this stage. You're going to end up with too many customers in too many segments, in too many places, and you'll never get to the next stage because you'll be burning all your money trying to treat, way too many different types of customers. And you are going to continue to experiment at this stage with distribution approaches, with various adoption paths, and you're going to learn what creates the greatest traction of growth. And you're going to keep learning this, unfortunately. I don't think learning ever stops in any company, as we all know. But this will be a continued stage of that learning. And if you get this right, hopefully you'll survive the day to sustain. And this is the nirvana of business. And I'll hand it to Bradley to talk about sustain.
If the audio is not right, just let me know. If you've made it this far, it's good. You've maybe cracked the hardest bits, arguably, but you're not out of the woods yet. So let's take it back to our case study, Acme. So they went through startup, and when they felt that they had a product that was working, they started off with dynamite. They decided to take Series A. They got a whole lot of salespeople on board, and then they really started to kind of crank the sales and the growth, and they're pretty successful at that. But burned pretty quick, right? Because they were spending to grow. So they took Series B as well, and Series B was around for further growth. They went into new markets geographically. They added a couple of products, big stretchy rubber bands and giant rockets that you sit on. And the business is actually looking pretty good. The fundamental unit economics is strong. The growth rate's good. The MRR rate's good. And so people overall are pretty happy. But there's a decision to be made because there's a lot of money still being burned, because it's being burned on continued innovation and investing more product lines and going deeper and improving the products, and a lot of CAC entering new markets. So there will be some type of equity event that would need to take place. So there's some options that the company has to decide between. They do a Series C on the private markets. There's one path. They've been private to now. They go a public listing, and they try to get their next round through that. Or they start trying to pull up the yoke before they hit day 0 to see if they can hit profitability before they hit either of those emergency points. And where this company's at is they've started to gauge the market, and they've started to talk to investors, and they've come up with a bit of a strategy here that regardless of what they do, whether or not they stay private or stay public, they have to be seen to be pulling up the yoke. And it's risky to leave it only to pull up to yoke without having a backup equity plan. So they're going to look at debt, right? That's the strategy. They're going to essentially use a debt instrument to give them a little more runway to give them time to pull up the yoke. And so the CFO, Yosemite Sam, he's changing the language that the business is talking to the investors, right? And this particular quote is actually influenced by something that is from real life. So there's a time in Xero's journey where they switched CFOs from Ross Jenkins, who was, I think, to a guy called, and Sankar's read on the word on the street by stage 0 was already in the public markets, was that people were no longer really after this just spend to grow, spend to grow, spend to grow, which was the line to the markets every year up until that point. The message that the investors wanted to hear is that we're going to switch the company now to be on a path to profitability. And this is a strategy that Acme is taking as well. And so what becomes important is suddenly other things. The aim of the game is to hit some kind of free cash flow, which is essentially, can you get more money coming into the business than going? Because at that point, you add into cash reserves. And so you've got a couple of things you can do with that cash. You can reinvest it in the business, or you can pay it out to your shareholders. And if you're reinvesting in the business, it could be to grow your teams, or it could be to acquire stuff. And that's a pretty common pattern with SaaS businesses. Once they've made this through, they start buying things that kind of lock lock in that area. And so the other thing is the EBITDA, and these are pretty related. They're measuring slightly different things. So obviously free cash flow is a cash measure. EBITDA ultimately is a measure of profit. It's used because it takes out some things around depreciation and amortization that tend to be a little bit different between industries. So it's better used for comparing across companies and benchmarking a company against others. And so what's going to become important to the stakeholders in the business are things like this, right? And the goals are to get these things and these curves moving in the right direction. And what will happen is that Yosemite Sam and others in the leadership need to select a strategy, right, about how they are going to get these things pointing in the right direction. And starting to think about how this affects you as a product manager and a product leader, the first question would be, will you have the opportunity to contribute to the strategy election that the company's going to make? That might not be possible. It might be a few pay grades above you, but if you ever do have that opportunity, I'd say take it, because it's some of the most influential decisions that would be happening in a company at that stage, and it's going to affect you, right? Whether or not you're at the table or not, it will affect you. And so even if you don't have the opportunity to be at the table, you need to invest the time to understand that strategy of the business and how people see how they're going to change these curves. And you need to think about how it's going to change your product strategy. So let me elaborate on what these strategy options might be and some of the metrics that the CFO and others will be looking at to think about where are the opportunities for us to start generating better cash flows and generating more profit compared to at the moment, which is essentially a rapid cash burn. So one of the useful ratios that's often used by investors but can be useful in a company at a time like this is to start looking at how much, the question is, how much are we spending the right amount on R&D? And so there's a ratio which is the R&D spend to ARR, annual recurring revenue ratio, and you see it quoted quite a lot in SaaS benchmarks. And the reason that this is useful is how can you quantify how much you're spending, right? Ultimately, it's a posture of your business based on where you are in your growth. So if you've got a more mature product that's kind of further along its product life cycle, so maybe it's kind of getting towards cash cow, right? Your R&D ratios are probably going to be pretty low. But if you've got some products in your portfolio that are still early, so that product in particular is earlier on in its life cycle, so it might be still in the startup or coming out of startup into scale up, that product, when you look at it, will have potentially a higher R&D to ARR ratio, but the company kind of is probably, certainly at the CFO level, unless your CFO really has a good read on product, they're going to be selecting a ratio that's a goal for the whole company. And then it's some budgeting process that's dependent on the company, right? That shakes out into which product managers are going to get which amounts of budget for where they're at. And so what you see, if you look at some of the benchmarks in the industry, and all of these figures that I'm going to be quoting are from an outfit called OpenView. They publish every year SaaS benchmarks and other types of benchmarks, but OpenView is a particularly nice report. So you can see as a business is maturing and 1 million to 1, 2 and up, that's all quoting ARR. And so you can see as the business matures, you start to drop towards R&D in the 20% range. If you're kind of in the teens, you're like possibly getting into a risky area where you may not have enough R&D to reinvigorate your product lines, to reinvent them as they might, disruption risk might take place. But you can guarantee the CFO, if you're in this kind of arrangement, is going to be thinking, how much are we spending on product and innovation? And so you might want to try to mix it and influence the thinking. And you might want to think about, well, my product line that I look after, where is it in its life cycle? And should I be starting to seed thoughts about, well, I think I should kind of continue growing, whereas potentially this other product line doesn't need to. The other thing or the other parts of the business that Yosemite Sam as the CFO might be looking at is how much should we spend on acquisition going forward? So in earlier stages, you're just pouring as much money as as you can that you've got into making sure you stay at over 100% growth. Because if you can stay over 100% growth, that signals to a lot of your stakeholders you can solve a lot of the other problems later. But there will become a time where you still need to kind of get in good ranges. And so the CAC to ARR ratio is the one that gives people a sense of whether or not you're overspending to acquire your customers. And so this ratio tends to be around 30% regardless of size. It kind of goes up and down if you look at it over size segments, but it's always in that 30% range generally. If you look across different companies, because obviously every company is slightly different, you get ranges between 20% at the lower quartile and 40% in the upper quartile, right? So if you're outside those bands, especially if you're outside on the upside, there might be some thoughts about, well, we need to look at our sales and marketing. So CAC is essentially the cost, as Colin introduced it, associated with acquiring the customer. So pretty much most of the people in your sales and marketing organization are going to fall into CAC, and it's those roles that are going to be the ones that people are interested in talking about. So those high-level metrics and those ratios kind of give maybe an initial starting point of things to investigate further when you're making this decision about how you change the way the company's spending revenue. So let's say that CAC ratio is pretty high. It's 60%, right? That seems abnormally high. It seems to be that you're in the kind of upper few percent of companies of your revenue size. So it seems on the face of it pretty expensive. Another way that you can dig into this is try to understand the CAC payback period. So this is a slightly more granular view about what's going on in your acquisition. So CAC payback period is trying to measure how efficient your customer acquisition is as compared to the revenue you get for those customers. And so the way it works is it looks at the number of months of MRR. That's not quite true, actually. That definition I got wrong when I typed it up. It's actually the number of months of margin, right, that it takes to recover your average cost of acquisition. So if you add up all your cost for a period, you look at the number of customers that you got, you get a sense for the cost of acquisition per customer, and then you essentially figure out, well, what is my margin per month? And then you divide the former number by the latter, and it gives you your months, right? And this is benchmarked as well. So it tends to be 10 to 15 months. Lower quartile, under 10 months, that's looking pretty good. In the worst quarters, you kind of up 20 months. The ranges do vary, right? And the reason that this is all interesting as a product manager is because if in a product company, everything will come back to product, right? So obviously, if the strategy is to save a bit of cash from not spending as much on R&D, your budgets are going to be constrained. And you need to think about that from investment cases that are likely to get sign-off, right? Because that's suddenly going to get harder for you potentially. In terms of CAC, it may be that there are things that you can do in the product, maybe the way that your free trials are working, or maybe the way that implementation, and create quite a lot of leverage rather than having the sales team work a little bit harder or your marketing team find a bit of savings. Potentially, you can come to the table and enable quite a bit of that improvements, right? So the reason that this is important is that one way or another, this will affect you. And we as product managers spend a lot of time talking about our customers and users and optimizing for them. And that's all good stuff. And that's always important. But you're part of an organization that has a strategy. And if you're in this stage, that strategy is going to become really, really important. So you may as well appreciate that and start thinking about how you contribute to that strategy. And maybe thinking about your product investments, not only in the eyes of your customer and your user, but also how is it going to affect and further these strategies that are more introspective and internal as well. Another thing that could potentially be a strategy is your gross margin, which is a measure of how efficiently you can service your paying customers. So you've got them on, right? And there's some costs that are associated with them continuing to pay you money. And so exactly what that looks like depends on exactly what type of business. But in a lot of SaaS businesses, it'll be things like your infrastructure cost or the cost of the people who care and look after your customers day to day. So potentially some portion of your account management team is considered cost to serve as well. or it might be customer success team, depending on what you call it and how your business works. There might also be some other types of costs that go into servicing those customers as well. And so essentially your gross margin is, you take your recurring revenue and you list your cost to serve expenses, so everything that's in that bucket, and that's expressed as a % of the recurring revenue, right? And so averages tend to be in 75 to 80. If you're above 80, you're generally considered to be in like gold class kind of SaaS gross margin. And so if this is poor, maybe you need to think about, well, what parts of our cost to serve are actually outsized here? Is it that we're paying way too much money to AWS because products are running super inefficiently operationally? And then start thinking about, okay, well, if gross margin is the major way that you're going to contribute to change in EBITDA, then let's look at some strategies to kind of drive that number out. And so I don't think we've got time for this particular extra for experts use case, but I'll stick it. But is anyone responsible for a product or a product line that doesn't have a revenue line, that it might be given away as a loss leader, or there's some other way that value is accounted for that doesn't appear on the books? Yeah, Workflow makes XPM, right? We should talk afterwards about ways that, the reason that that's important is because if you're a product manager that has a product like that, sometimes it's really regulate your contribution to the business, and you get squeezed out in terms of investment because the value is buried and it doesn't appear on the CFO's like accounts essentially. So been through that, skipping over that. So
do you want to just mention, I think it'd be worth like shadow P&L, what were you thinking, shadow P&Ls or attribution? Just for a couple of folks on the live stream, just give them a few tidbits on that.
Yeah, it might be worth talking about, because I think I've heard recently that with the COVID situation, like a lot of businesses have been thinking about like how can they support their customers, and they've launched a lot of free products to the market. So I think it's something that's quite common right now.
Yep. So the situation that I had at Xero is that we had a product that was both sold to segments outside accountants and bookkeepers, and then given away to accountants and bookkeepers. And the proportion of customers that were accountants and bookkeepers was pretty material. And so we knew the line item for revenue, but the R&D line was not only contributing to the revenue, but it was contributing to all the stuff that we gave away. And so one of the strategies to kind of make up the difference is essentially we described the product as, and this was an internal thing because finance wasn't going to change this, but talking amongst stakeholders and people that were making investment cases, we essentially took the cohort of customers and we gave them at a nominal price, which was influenced by a couple of things. One of them was, what is the price that the other segments were paying? Because that's a proxy for potentially what the segment would pay. And can we look at other products on the market that do a similar thing, and what are the price points that they achieve? So we essentially just created an average revenue per customer number and then multiplied that across the accountants and bookkeepers that were given away for free, and then added that to the revenue line. If I recall, we had $13 million of actual revenue, but $21 million of value overall. And so when we're thinking about the R&D, when budgeting time came, it was like, let's work out the actual amount of R&D we should be spending on the 21 million, not the 13 million. And that also kind of helps make sense of the other metrics. But if also you're in one of those cases, it might be that you're flying under the radar and no one knows about these metrics because everyone, certainly Xero, all the metrics were associated with a Xero mainline product, right? No one really understood the nuances of the businesses for any of the other metrics, right? And so starting to develop that also helps discussions with other parts of the business in terms of your relationship with them. So at a kind of high level, it's a tool that you can have at your disposal as a product leader that helps you reason and justify business cases and talk to your stakeholders, especially when it comes to the purse strings. Implications for product managers, just in summary of that whole thing. So the difference between your current and your desired R&D to ARR ratio is going to impact your growth and spending. So if you've been doubling your R&D team every year, guess what? That might not keep happening, and that'll be painful potentially. And you need to anticipate that, but B, also think about if you need to kind of start influencing why that's not right for you. And when you're putting up investment cases, you need to be cognizant if you're going to go against the grain of this, because you need to be really tight on why this is a good idea, especially if money's been easy to come from in previous financial periods. A desire to drive down CAC or CTS, it's going to create objectives for the product strategy, right? So you need to appreciate that, because that might be different to what you've historically been focused on in terms of customers and users, right? It might be a different lexicon that's going to resonate with your stakeholders, right? So it might be something to be politically cognizant of, because if you're ignorant or out of step of these strategies, guess what? Like, it's politically, it's going to be difficult for you, right? It's much easier to invest the time to understand this and be able to articulate that and speak the language of some of the other senior leaders in this business, where they're going to be closer to these investors and these stakeholders, and going to have to be thinking about how quickly can we get this yoke to pull out, how much do we need to go and get bridge funding or loans from the bank, you know, to get us to our next step. I have no idea what that is, so.
I was like, oh, I thought you both added some bonus material in your slides that I didn't have.
I guess just a quick bonus piece, and why you want to develop financial discipline. Look, the slides on the Slack channel and the general channel, if you just look for me, and Tokes actually added some pieces here. This was a cut of a slide from a board deck where a head of product was at ChargeBee, was sharing. These aren't the real numbers. He've changed them to protect the innocent, but how he talks to the board about what they're doing in product. And you'll notice a lot of it comes back to, what are we doing in ARR? What's the ARPU? What are the total number of customers? It all brings it back to financial metrics. He's not talking about, here are the 6 features we launched and why they're so cool, and our users NPS score, etc. And so as you try and step up into product leadership roles, your job is to actually try and create space for your product teams to go do really cool stuff, which means you've got to talk to the stakeholders in the language they speak. And personally, it's a struggle for me. I get very excited about some of the stuff we do and some of the things, the conversations I had with customers. But at the end of the day, I'm continuing to learn. My board is there to govern and make sure I'm spending my money wisely. And so how I do that in the internals is up to me. But what they care about is the impact to these financial metrics. And so developing that awareness, no matter where you are on your product journey, if you own a piece of a product to a whole product, to your organization has a single product that you're leading, we think it's really important that you start to develop that conversation and get to know. And because it's going to be important to step up into these roles, because you're going to have to, at some point, talk to the folks that think about really the dollars at the end of the day. So that was kind of where I'd end off, is your future is always in finance in some way or another. All right, questions?
Got the microphone here. Just a quick question to the audience before we get into the Q&A. How many people in the audience use any of the metrics that we've talked about tonight in their day-to-day or week-to-week or month-to-month activities? Let's get a quick show of hands. Not very many, right? How many people will start using these things in their day-to-day as a result of what they've heard from this talk, or think they have the opportunity to start in their organizations? That's very interesting. I'd love to find out more about that later on. So yeah, so anyway, we'll take some questions now. Chipra, have we got any questions from the phone?
Nothing at the moment. I'll give them a few minutes.
Cool. What about questions in the room? Karina? This is for the live stream, just so that people on the phone can.
Well, first of all, thanks so much. That was super interesting. And I love the focus on the business impact. And I absolutely agree. There's like a massive gap and something we should all upskill on. I had 2 hopefully quick questions. One, I would love to hear, Colin, about the non-spreadsheet automated ways to calculate CAC. And then secondly, for you, Bradley, you mentioned the customer acquisition cost versus annual recurring revenue. So I was curious why you picked that over customer acquisition costs over lifetime value, because that's a common metric I came across. So yeah, I would love to hear your thoughts.
So we'll start with the tooling side. This is where you can sit beside your finance team and help support them. a lot of them are asked to come up with some of these metrics in board presentations, and you know, the reality is there's a lot of actually really cool financial tools out there. You know, Adaptive Insights, ProfitWell, a number of these tools that if you tag your data in the right way, start to spit some of this out. But the finance teams are often so busy with month end, year end, public reporting, et cetera, they never get the time to do this. So as a product leader who wants to tell a story about your product, you got to find your finance business partner, and you've got to kind of get with them and try and figure out how can we support each other, so that you can provide some really cool stats and make you look like rock stars, and help me justify really cool decisions for my customers. So there are tools out there like, you know, Adaptive, ProfitWell, and others. Your finance team probably has a wish list. And again, you can help support them getting the tools they need so that they don't have to sit there and manually chunk through these numbers in Excel every month or every time somebody asks for a report.
Need more hands here. No, I think I'm good. Okay, so the question was, although you're the mic, so I think everyone knows it. So why did I talk about CAC to ARR ratio as opposed to, say, CAC to LTV? So one is a macro measure and one is a unit economics measure. So when you're looking at something like CAC to ARR ratio, you're actually looking at the business overall. So this is just called CAC to revenue. So you're trying to figure out, when you're looking at these, like, where is the business spending its money? Is it spending it on R&D, or is it spending on an acquisition, or is it spending on essentially the cost to serve your revenue? And so all you can really answer from that is, do I spend in a mix that seems similar to other people in similar businesses, right? You anything about whether or not you're spending the right amount for each customer, given how much customer is worth. And this next metric, CAC payback period and CAC to LTV, is kind of measuring the same thing. It's essentially trying to figure out, is the amount that I spend to acquire a customer about right given what they're worth to me over a period of time. CAC payback period also factors in margin. And so it's useful to have both, because if your margin's the problem and not the acquisition, right, you might see that if you only look at CAC payback period. So if you look at both together, you can kind of isolate the impacts of each. So hopefully that made sense.
We've got one question online from Sachin. How do you see a PM playing role in a system integrator type organization that doesn't have any product thinking embedded?
So yeah, look, I've seen that out there, and I've seen SIs try and become product companies, and some do. Look, I think part of it starts with, you know, the reason you start to ask some of these financial metrics is you actually also learn what type of business your leadership thinks you're in. So if they're not, you know, if your CFO is not asking you about CAC and CTS and R&D, you may not be in a product company. You may just be in a company that just makes money year on year. And so the dialect to which your finance team and your finance team uses tells you a lot about your type of company. And it's going to tell you a lot about what you can do inside that company. And so I think things like the R&D to ARR ratio, let's take ARR as an example. Do they even talk about recurring revenue, or is it all basically, as long as we make revenue and profit and the margins there, I'm happy? That tells you a lot about what you're going to be able to justify. And so if you show up at the CFO's door and say, I want to spend this really big amount of money to get this little bit of ARR for this lifetime of this customer, if they don't already talk in those terms, that's probably not going to be the business case that's going to get you there. And so it's important to actually have these questions with your company, because it's going to help you learn how to push the levers. And so we're talking here mainly about companies that already know that they're SaaS companies that tend to measure these things, but there's a lot of companies that are blended out there, and it's going to help you figure out at what level does that, your product thinking stop, and it just becomes a general, I'm a business to make money, and I'm not building a sustainable recurring business. And look, I don't have answers, but it's really telling when you start to ask some of these questions like, hey, what's our LTV, what's our CAC, what's our ARR, and what's in our ARR? because I've also seen businesses who play with definitions of what is ARR. So, it'll tell you a lot about your company, and it'll also set your expectations of what's possible. So that's my advice. I don't know if you got some others.
I don't know if it's advice, but I think the one thing is, I think sometimes, I don't know if you can change the situation, but if you were to, I think it's really good. You need to meet them where they are, right? And what's the language that they're speaking when they talk about value, right? And then you need to kind of unpack that and then take them on that journey about the product value and to start talking about some of these financial metrics. But it is a hard journey if you're not there yet, or if there is no realization in the organization that they want to move in this direction. But you can make an attempt to start having that conversation. But I think you really need to start where they are. I think sometimes even for us as product managers, it's hard even to stop to think about the metrics in product and take a step back and go, okay, let's talk about the metrics of the business and work those metrics for the product in, right? It's a very similar, I guess, journey in that respect of, hey, what language are they speaking? What are the finances that they're tracking? How do they think about the business? And, would they be open to having a conversation about those things and starting that conversation? So I don't know if you can change it, but certainly I think if you were going to attempt to, I'd probably be thinking about what do they currently measure? What's currently important to the business? How do they measure value? And if we started having this conversation, are they actually open to talking about it further if I can position things?
I'll add one more piece to that. You can also start to form some of the change. One of the conversations that I might want to have in that business is that as an SI, I generally sell bodies, which means every dollar I've got to work hard for. Whereas recurring revenue, I've got to work hard to get it in the door, but once I get it in the door, it's basically easy money minus cost to serve post that. And so you can start to shape that influence as to why you want to make an investment in products and why you want to commercialize it in a certain way, because especially SIs know this, when the projects dry up and the times are tough, you start laying off the people. With a recurring revenue business, if you've got a fairly secure recurring revenue stream, you can weather a few more storms. And so again, you can use some of this language as well, maybe to spark some ideas, but you got to kind of, as Audrey said, meet them where they are, understand where they're at, and then try and take them on that journey one step at a time. Questions?
Yes, thanks for the talk. My question is around if you guys have any advice on, we talk about MRR churn rate and CAC and stuff, right? So do you guys have any advice on how to identify whether a certain feature could impact on that specific metric? So for example, how do you go to your board and say, oh, this initiative or this feature A or whatever would reduce churn rate from 8% to 5%, for example?
Right. Yeah, I think from a feature perspective, I think what you can be talking about, so if you're thinking about churn rate, I guess you're looking at your churn reports, what customers have churned based on specific reasons, right? They're not always a singular reason that a customer is churning for, but I think some of those things can give you an indication of directionally, what is the reason that people are leaving? And it might not just necessarily be a feature. It might be that you're not able to solve a problem in part of the job, and then they're not seeing the value in what they're purchasing, right? So I think you need to unpack some of those problems and kind of work out, well, how many customers did we lose? If you do find that it is a feature, how many customers did we lose because of that, over what period? And if we did have it, would we have been able to retain them? And I think you need to start thinking about it from that perspective when you think about churn prevention, right? What are the reasons people are actually leaving your business? You can quantify it based on what their MRR or their ARR is, what's the size of them? What was the upsell value opportunity for those? So we lost the opportunity to sell them the larger package because even though they were a good customer, we weren't able to solve X problem for them, right? And I think when you look at the reason why people were churning, and you can quantify that holistically, that there were more than one customer that churned because of that, you start to paint a picture of what that is. You can couple that also with, even churn interviews. If you've done that with customers who have left your business and you interview them as to the reasons, you can couple that with the sentiment of, how meaningful that was to them. I think those stories really help to tell the story of why something's important and help you to build the business case for it. One of the frameworks that I like to use in general is Lean Canvas, not because of the specific framework itself, but I really like that it asks you a lot of questions that you should be thinking about, like what problem are you trying to solve and why? And you quantify the opportunity there, and you quantify actually the you know, what it would take to actually solve that problem. So it just gives you a framework to ask yourself those questions and to build a story of value, so that when you're talking about one thing over another thing, that you actually have something to lean back on as to the why behind it, what it would cost, what the opportunity and what the upside and value is for the business. And I think when you can put it back to the value, it's a much easier sell than kind of saying, well, you know, I kind of have this feeling that, you know, these customers left for this reason. Well, you know, like there's there's, you know, maybe 10 or 100 customers on this side who want this new feature that we could sell to, right? You're always going to have those trade-offs between churn prevention and, you know, getting a new deal. And you're going to have to find a way to actually balance between those two things and convince based on the value to the business. So I would be looking at some of those things to help you build a case for it.
I was going to add one other thing. I think a common out there is people do try and assign, if I build this feature, it will generate X dollars, and they're looking for that answer. It's really hard. Sometimes you actually have to roll it up to kind of more of an objective level. If I solve this category of problems, I can obtain more share of market. You know, so you've got to kind of tie together a few features and tell a wider story about a theme you're investing in, and that's actually the financial driver. So financial metrics sometimes don't always fall down to, as Audrey said, customers rarely leave you because of one single feature. It's usually a combination of things. So if, you know, try and maybe sometimes think about it, if you're struggling to get it down to the feature level, it's a theme. We're investing in this area. I'm presenting, you know, X percentage of my limited R&D budget in it, and we think that that's going to drive ARR or prevent churn in this area. So feel free to roll up to get started. And then if you can see a connection to break down, that's great. But also there's a level of precision there that you don't want to chase because you're just going to waste your time. Because again, it's still about movement and action, not just trying to figure out the perfect business case down to the penny.
If you're, I'm going to leave you to hold that. I'll be quick. If you're, I'm not suggesting this is the case, but if you are in an organization where it's expected that you rationalize the commercial ROI of every single thing that a development team does and a product team does, it's not a great place to be. Find another company.
There's lots hiring. There's another
one more
question.
pitch. One more pitch.
I'll keep pitching. Yeah.
Hey, so just a quick comment from everyone online. They've really enjoyed the Looney Tune references, so thank you for putting that together.
It's good. We don't feel that old now. Yeah.
And yeah, thanks from Sachin for answering that question. There aren't any more questions, but if I may, oh, actually, sorry, there is one more question just now. So I'll ask that. Sounds like many of the speakers are not from New Zealand, American maybe.
Go north a few more degrees.
How different is the SaaS scene in New Zealand and the standards of how the companies speaking in product language different to American scene?
Neither of you guys can comment.
Yeah. Audrey, do you want to? First, you want to correct them that we're not American?
We're not American, out and about.
That's what it's all about, eh?
Yeah, it's about that.
A bunch of hosers out there, eh?
You know, I think product management in general, I think everybody's on a learning curve, and I don't think actually New Zealand's behind, to be honest. I mean, I work with a lot of American organizations, and I do actually think that, you know, it's great that we have such a vibrant actually product management community. I think, you know, in terms of the SaaS metrics, I think it's, you know, it's widely varied, just like any other place, right? Like, I think, you know, we do our best, we try and learn, we try and share. I think the one great thing about New Zealanders is that we do share our stories. You know, we do come together as a community, and I think that's really like fantastic. And so I think we are learning from each other. There's a lot of there's a lot of places to gain knowledge and to learn from other people's experiences. And I think that that's the best way to upskill ourselves.
Just before we move on, I've got a question for the audience and anyone online. So you've got Sylvester, Tweety Bird, Granny, and the dog. Does the dog have a name? Does anyone know the name of the dog? If anyone can tell me the name
I'm
of the dog,
Googling later for that,
The,
Bradley.
the internet, the online folks are all searching now. Is there a prize, Bradley? Are you offering 1 hour free consulting? The other thing I would add, the one thing I have observed about a lot of New Zealand companies is we have a lot of boards and CFOs that actually don't come from, this is their 7th SaaS company and their previous founders that have exited recently. So there are a lot of folks that actually are back to the financials. So actually your upskilling on financials is going to help you engage with some boards who are here for all the right reasons. They want to grow New Zealand talent and export dollars and all that other stuff, but actually they may not be familiar with CAC and the value of certain types of revenue and things like that. So this is as important for them to find a way to have a dialogue with you. And this is where I go back to defining language in the business and having a common dialect. And it's going to help you, it's going to help them, and hopefully it'll help you be successful. So yeah, I think definitely the more you pay attention to this, the more you have a better conversation, then hopefully you're part of some businesses that exit and do well, and you can go influence other startups, and we can get more switched on boards to SaaS, and the wonderful opportunities are out there.
We'll take one last question from down the front.
Hi, thanks for the talk. It's very interesting. So my question is, with the NRR that I think Colin mentioned, so for companies that you've seen that are like doing positive NRR, so year on year, either retention is pretty great or they're managed to upsell clients, what are some interesting leading indicators you've seen for that? It might be hard to generalize, but I'm just curious.
Yeah, look, I think if you're in a, so when contracts come to renew, depending on the size of the market you're going after, in enterprise software, I can tell you generally it's all about discounting at renewal time.
Yeah.
Whereas when you're in consumer, it's all about upsell. Netflix, your Netflix rate has probably gone up like mine has every couple of years. So to me, the I guess there's some philosophy as an organization. Are you going to grow NRR by selling add-ons and upsells? Are you going to try and move them up in a kind of an addition or a tier? Are you going to introduce a consumption-based component into your pricing? So thinking about your unit metrics, there's a couple of different ways to drive it. But that being said, going back to the CAC recovery period, at some point, the magic of SaaS is that customer is mostly margin. And so actually it's not always about NRR growth. It's just making sure it's not falling at a rate where they just fall too quickly, because you're still trying to feed the start of the funnel. Your sales team isn't, done after the first 100 customers. They're hungry for more because they get paid for acquiring new customers. And actually, outside of a few businesses where you become very sticky, there's very few that are going to keep customers literally forever. So you kind of, NRR is not the only side. But that being said, if you don't watch it, and you find you're doing all this work up front to acquire customers, and they drop to a fraction of the value 2 years in, you got a problem in the back book. And I find there's a lot of sales teams that are very excited about the front book. Nobody talks about the back book. So that's why I like NRR, because it balances out the equation. It's not always about acquiring new customers, it's about making sure that the existing customers are playing out as I expected based on the original business case I wrote.